From downtown Milwaukee, welcome to Money Talk with Bob Landaas. Each week, professional advisors from Landaas & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for August 16th, 2024. Checking the calendar. The Brewers are in town for the weekend with the Cleveland Guardians, and Saturday is Bob Uecker Bobblehead Day. A fun event also this weekend is Zoo a la carte, and of course there's Irish Fest. Wait, there's more. Cigar Fest Saturday at the Varium Beer House, and Sunday it's the 11th annual Puerto Rican Fest at Veterans Park. And also this weekend, it's the Kenosha County Fair. That should be enough. Let's begin our journey into the weird. Remember when retired guys would walk the Florida beaches with their metal detectors? Well, Hurricane Debbie has churned up the ocean around Florida beaches to the tune of $1.5 million of cocaine. Just thinking out loud, if you lived in Florida, wouldn't you want to trade in your metal detector for a drug-sniffing dog? In Iowa, a son shot his father because Dad said he had stinky feet. Dad's going to be all right, but the son is going to prison, and the Bureau of Prisons has a policy against bare feet. Thank goodness for that, said the other prisoners. And finally, South Korea has deployed a bed bug sniffer dog at the airport. This is to stop bed bugs from entering the country after the Paris Olympics. So what does that say about the French? On the podcast today, we have Steve Giles, John Sandstrom, and wrapping up the week, here's Kyle Tedding.
Well, thanks, Max. A great week for stocks. NASDAQ up 5.3% this week, up 886 points. S&P 500 added 210 points this week. That's 3.9%. The Dow Jones Industrial Average closed Friday at the bell at 40,660, up 97 points on Friday, 2.9% for the week. For the year, NASDAQ up 17.5%, the S&P up 16.4%, and the Dow Jones up 7.9%. I think it'd be easy enough, Steve, to maybe just leave the podcast here for the week. 7 straight days positive for the S&P 500. Probably not much more we need to say, but I think maybe a reminder for investors that despite the strong run, we are coming off what was a rough couple of days, now going back 2 weeks. And, I think when we talk about where we've been, there's some conversation on maybe what's left here.
Yeah, isn't it interesting that the data we saw last week led to a couple of big sell-offs in the market? Everybody was very worried, and the difference that a week can make. We had some very strong economic indicators, whether it was inflation, retail sales this week, that have now got the major indices back to within their highs from earlier this year. S&P just 2% off that all-time high we set last month.
I think the challenge in looking at all-time highs is it sets this expectation that that's where we're supposed to be. And I think the reality is we'll get there. Stocks over time go up, and we'll be back to those numbers eventually. I think the more important piece, though, is looking at just how strong of a stretch it's been since. And I think that reminder that, the reason why we talk about balance, the reason why we talk about building portfolios that aren't strictly susceptible to stock market decline is that stretch we saw 2 weeks ago. And now you're getting the benefit of not overreacting because you were properly allocated.
And I also had to remind myself that as somebody who does this on a daily basis, and we look at the markets daily, sometimes hourly in between our appointments, we can get caught in the minutia of the minute to minute. But for the average investor, they might be lucky to look at their account statements but once a month. This is not even going to show up on their reports at the end of August, assuming that we don't have another huge run-up or a huge sell-off. But the point being is that, over time, the markets are going to trend up. And at the end of the day, if you focus on laying the groundwork for your allocation, putting together a plan that no matter what the economy throws at us, you're still going to look smart longer term.
Steve, buried in that great comment was something that we talk to clients about all the time. And John, maybe a good opportunity for you to chime in here on just how often you should be looking at statements. Because to Steve's point, if you're not looking at this every day, you probably missed the fact that we had 2 of the worst days we've seen in a very long time. Yeah, you're ecstatic now that we had a 7-day winning streak for the S&P, that we're back near those all-time highs. But I'm sure clients call you quite regularly saying, hey, I just looked at my statement and things look terrible. My usual response is, hey, maybe stop looking at statements, and when we talk, I'll tell you what you need to know. That's an off-the-cuff kind of joke, but I think it speaks to the bigger picture, which is the more often you look at this stuff, the more you're going to drive yourself mad. How often, John, should be clients looking at this kind of stuff?
I always say that it's something you want to make sure that you are where you're supposed to be and you're sticking to your allocations, your plan, keeping up to date on that kind of stuff. But, I mean, if you're trying to look at these statements, like you said, every week or every other week, you're going to start to drive yourself crazy, especially in these volatile quarters like we've had. It's going to be up, it's going to be down from day to day. If you're looking at this stuff every single day, you're always going to be thinking about what the right move is going to be and if I'm making the right moves. But, I mean, if you look at this stuff every quarter and you know that you're sticking to your plan that you set, you should be in a good spot and set up for the future.
But don't fall victim to the never looking at your statements at all, John. And I think once a quarter, revisiting your allocation is probably a good starting point, depending upon where you are, whether you're in the still working and saving for retirement versus the hey, I'm retired and drawing income stage of your investing life.
So my son was playing a hockey tournament in spring. He took a puck off of his knee and went down pretty hard. I had to go out and kind of make sure he was okay. I took him off the ice for a minute to kind of check his knee out, and he goes, Dad, it hurts when I do this. And the typical dad response is, well, then don't do this. So what we say to investors.
Tell him to rub dirt on it too.
Yeah, I absolutely gave him the typical dad response. But I think, when we talk to investors about the pain of looking at that lower number, the kind of immediate response is, well, if it hurts to look at your statement, just don't look at your statement. But the reality is there is a lesson in that pain, right? Your body is telling you, hey, maybe take it easy. Maybe don't push yourself quite so hard through the rest of this game and give yourself some time to recover. And I think the lesson for investors in that pain and looking at statements is maybe I'm not properly allocated. And Steve, I know that's a conversation you have with clients all the time is, right, this is the importance of balance. That pain is giving us a lesson in precisely how we're supposed to allocate.
Yeah, and to the point about pain there, as humans, emotionally, we experience the sensation of pain about twice what we experience the sensation of the gains on our statement. So if you look at your statement and it's down 1%, it's gonna feel like it's down 2%. Where if you look at your statement and you're up to 1%, it's only going to feel like you're up 1%. The point being is emotionally, I think that we can get in the way of ourselves if we look at our statements too often.
Yeah, Nobel Prize-winning economist Daniel Kahneman spoke of loss aversion, right? This desire to avoid the losses more than there's a desire to have the gains. And, I mean, you win a Nobel Prize for studying that kind of stuff, it probably tells you there's some truth to it. And I think to your point, we hear it every day. John, a big week for economic data. We had spent really the last couple of weeks wondering just how strong the consumer really was, wondering if we were going to be able to get through a stretch of softening inflation, softening economic growth without the consumer really stalling out entirely. And we got some news on retail sales, some earnings on some of the kind of consumer front. It seems like things are moving along okay, certainly better than we thought.
Yeah, and I just want to touch on one thing that we talked about on last week's show, and Steve kind of alluded to it before, is something that caught the headlines and really drove the markets negatively last week was a slightly worse than expected jobs number. And a lot of people were saying, hey, this could be the beginning to a consumer that's not as strong as it should be. But then we get all the numbers back this week, as you said, and consumer sentiment rose for the first time in 4 months. Retail sales were up 1% from last month. And then we have PPI and CPI continuing on the trend that we're looking for. And all of this kind of points to a stronger consumer for the future. It's obviously we still got some ways to go on that front, but I mean in a economy where 2/3 of the GDP is on consumer spending, seeing these kinds of numbers is pretty promising.
Yeah, I think a reminder that while we're not there yet with inflation, producer prices a little better than consumer prices. Producer prices tend to be a leading indicator for consumers, because if your input costs go up, then you're going to sell your good for a little more or your service for a little more. And so we do keep a close eye on that stuff as it relates to expectations for the Fed. And I think it speaks to the fact that the Fed can now basically spend their time focusing on jobs. If you have a dual mandate, full employment, and roughly stable prices, I don't think 3 or 2.9 is stable just yet, but we're close. But if the environment is continuing to shift in that direction, it's clear the Fed has the clearance they need to make that cut when it comes time in September.
And for those listeners that are wondering what normal is, Kyle, the Fed wants to get to that 2% inflation number. The numbers we saw this week had headline CPI at 2.9. Our 20-year average for inflation is 2.4%. Our 10-year average for inflation is 2.6%. So we're actually very close to our average, just not down to the 2% that the Fed certainly would like.
And what I love about the data, and something that we were talking about before the show, Steve, is how much nuance there can be within category. You were pointing out in the July CPI report just how big of a component or how big of an increase the things like motor vehicle insurance were. Similarly, you look at the sales, the retail sales, and car sales were a big component of the increase. Even absent car sales, we had a pretty meaningful retail sales number beyond that. But, you know, it's interesting to me how much nuance there can be month to month, and some of that inflation data in particular.
Well, and what I found most striking in the data was that non-alcoholic beverages contributed a 0.5% increase in those inflation numbers, where alcoholic beverages were only up 0.3%. I'm not sure if there's something to read into that or not. I guess time will tell.
You know, I was joking with a client in my afternoon meeting today who holds some shares of an alcohol manufacturer about how poorly they've performed this year. And I pointed out that alcohol tends to be a stock that does pretty well when markets are down. When people are miserable about the way their investments are doing, they tend to spend a little more. So maybe that's why non-alcohol inflation is a little higher right now. You know, I think more than happy with the week we've had. With a Harry Doyle bobblehead come tomorrow with the Brewers, here's probably a good place to leave it. I would encourage you all to keep tuning in. We appreciate you listening and looking forward to talking to you again next week.
Thank you for listening to Money Talk with Bob Landaas. If you have a financial question you want answered on next week's show, email it to moneytalk@landaas.com. To keep informed throughout the week, visit our Money Talk page at landaas.com.